As a #1 company in relationship-based pricing and billing, SunTec enables enterprises to deliver the promised value to their stakeholders. With 125 plus clients in 45 plus countries, SunTec is a trusted partner of leading organizations across the banking, financial services, insurance, telecom, and travel industries. Headquartered in India, SunTec has operations in the US, UK, Germany, UAE, Singapore, Canada, and Australia.
A very good morning, good afternoon, and good evening, everyone, and welcome to SunTec's webinar on building a resilient retail banking distribution strategy. I'm Ashwati from marketing at SunTec, and I'll be your host for today. And I just want to get us started off by setting a brief context for today's discussions as well as presentations. Now, given the global pandemic and its impact on mobility, retail banking is impacted with a marked decline in branch traffic. And as the economic fallout spreads and in some geographies worsens, banks must brace themselves and build a resilient and agile distribution and servicing model so that one, they can continue to enhance the customer experience, and second, and very importantly, ensure that the pandemic does not impact their ability to grow deposits, service their customers, and expand wallet share. We'll hear a lot more about this from our speakers today. All right, so given all that, to move on to the awaited part, as you know, we are hosting today's webinar in partnership with the global strategy consulting firm, Simon Kucher and Partners, and it is my pleasure to introduce the team to all of you, starting with Managing Partner, Dr. Wei Ke, who currently heads the company's financial services activities in North America. His experience includes advising leading banks and financial institutions on pricing strategy, customer value management, risk management, value communication, consumer behavioral biases, and big data analytics. Joining Dr. Ke is partner David Chung, an expert on pricing strategies, price model design, segmentation, and price implementation. His consulting work focuses on value management, strategic pricing, and product optimization. And senior advisor Rick Spear, whose major focus is both a management consultant and as a business executive, has been growth through business model innovation and optimization. In addition, he has expertise in designing and leading profitability programs too. So now over to you, Rick, David, and Dr. Ke to share your valuable insights and outcomes on the topic from your recent survey.
Thank you very much. Hi, I'm Rick Spear, and today we're going to discuss building a resilient retail banking strategy. We're going to give perspectives on how financial institutions can better respond to the changes precipitated by the crisis. So if we can go to the next slide. So resilience is a metaphor that's rooted in material science and that's dealing with inert objects. So external shocks are forcing the inert object to respond if it either rebounds or it breaks. COVID, though, is more than a shock, and banks are more than inert objects. They're dynamic organizations. So resilience in this context really requires understanding, and it requires adapting. And our view is that it really means evolving the omni-channel business operating model that's driven banks and driven their interaction with customers. But it raises the stakes around that. So the 60% number of a bank's expenses, can banks actually serve customers well going forward if 60% of their operating expenses are absorbed by the branch network? And that 50% number really raises the question, can banks really continue to win if 50% of their digital CapEx spend is ineffectual? So what we're wondering is whether banks really have a check-the-box digital innovation strategy, or are they really driven to survive? Are they going to evolve? And if we sort of compare and contrast two very visible case studies, one with JP Morgan Fin, where at least JP Morgan did fail fast, even if they failed expensively, and Goldman Sachs' Marcus, which came out today with a $20 billion increase in its deposit base to $92 billion, perhaps they're showing that there's a path forward that can work. So if we go to the next slide. What we did is a study where we polled over 1,000 respondents in the US and also 500 in Canada. The results we're looking at today are the US results. but we compare the outcomes across both countries. In fact, the trends and the takeaways are similar. And the first question really asked was about mind share. And what you see is an incredible correlation between branches and mind share. So JP Morgan, Bank of America, and Wells dominate branches, and JP Morgan, Bank of America, and Wells dominate mind share. So what this says is that post-COVID data, in fact, states that branches are part of this lattice structure. We go back to our inert material metaphor that makes banks resilient. So let's drill down on this. Let's go to the next slide. So in fact, customers are telling us outright in this slide, if you look at the far left, the 54%, 54% of respondents say that they will open a new account with a bank that has a physical branch only. There's a large group who are indifferent. They'll do either. And there's a very small percentage that will certainly just do a digital only solution. So what are customers telling us? The customers, on the one hand, we're saying that the new normal may require a step change, right? You can't just simply accept 60% operating expenses in branches, and you can't accept 50% failure in your CapEx and digital. But on the other hand, customers are saying they don't seem to want or trust a digital-only solution. They're saying, in fact, watch your step change. So what does this mean? On the one hand, you have Marcus, which is getting 25% increase in deposits versus JP Morgan's only getting 7% increase in deposits over the year-over-year comparison. So I think that David will help elucidate that in the next set of slides.
Great. Thank you, Rick. In our next set of questions, we also explored switching behavior. And for example, if their bank's local branch were to either temporarily or permanently close, basically, what is the sensitivity of the customers to branch closures? On the left-hand side here, what you see is that 26% of respondents would move at least some of their business if their branch would close close temporarily. Whereas if they were to close permanently, it would jump to 65%. What this says is that even banks with a healthy mind share will lose customers to other banks if they close, all else being equal. And for me, it actually raises this question: what do banks need to do to prevent this movement post-COVID? And this essentially leads me to my next couple of points. We also asked about preferences for digital services before, during, and after lockdown. And in comparing these time periods, there are two clear trends. One, there was definitely a bump in preferences for digital from before to during. So if you take a look at the gray bar to the light blue bars, you'll see a moderate increase in each of the different columns here. And the second clear trend is that after the lockdown, they all reverted slightly downward, but still remain above the gray bar. So if you take a look at the trend from the light blue to dark blue bars, each one of them actually slightly decreased, but they are also greater than the original gray bar on the chart itself. So what this suggests is that the digital activities, I think, as we all know, will continue to stick post-lockdown. We see the biggest differences in preferences for mortgage and savings on the left-hand side here versus bill payment, all the way on the right at 29% and 10% for mortgage and savings, respectively. Interestingly, the ones with the greatest increases, such as mortgage, also have the lowest absolute preferences. And arguably, these may be where the opportunities for low-hanging fruit may be to improve the overall digital experience for customers. In another very interesting finding is the willingness for customers to travel to conduct in-person transactions. So first we asked, what's the average travel time in an urban or suburban setting? Then we asked, if a bank were to offer best-in-class digital services or digital capabilities, how much farther would they be willing to travel to get the in-person bank services that they need? And what we found was that in an urban setting, they would be willing to travel 31% more in time, and it almost doubled in terms of travel time for suburban and rural settings. So 72% there, as you see on the right-hand side. Why is that? Our view is that for banks that offer best-in-class digital capabilities, they're likely satisfying a large portion of a customer's banking needs. So when they need to travel, there's a higher necessity for those in-person interactions. But also the customer would need to make fewer trips. Now, what does that mean for the branch network? Well, we looked at the branch gravity field. Well, we looked at it from a branch gravity field perspective. So essentially, how much business within a certain radius of a branch can be captured, and typically, the farther away from the branch, the lower the acquisition. From our view, with the added power of best-in-class digital capabilities, banks are able to expand their branch gravity field. So using very, very simple geometric calculations, we estimated that there's a potential to reduce branch density by 42% to 66%, depending on the setting. So whether it's an urban or a suburban or rural setting. And this is a huge impact on the need to maintain a very large branch network. So I think from our view here, the key takeaway is that significantly enhanced digital capabilities increase the tolerance for customers to travel farther to branches, which then unlocks opportunities for banks to rethink their branch network strategy. And now for the last few slides, I'll hand this over to my colleague, Wei.
Thanks, David. If you could, yeah, great, thanks. Actually, go back one slide. If you think about, what David just said, there's potential to reduce the branch density, but under a caveat, in exchange for best-in-class digital capabilities, right? So otherwise, customers probably don't want to do that. And when we actually went out to survey, the same respondents on how they feel about digital capabilities offered by the industry today. What you see here on the left-hand side, a few bars, the overall satisfaction is not that great. This particular question was on whether this particular customer is actually completely satisfied with the digital offering from their primary bank, so digital capabilities of their primary financial institution. Of a top 4 national bank in the US context, about 40% of the customers say they're completely satisfied, and that also means the majority, 60%, have something to complain about with the primary bank's digital capability, in this case for the top 4 bank. Of course, the number slides down, as you go down in size. What's interesting is if you look at the bar that says 53%, which actually corresponds to digital banks and neobanks. And even for those customers, you would think these digital banks and neobanks are by default digital, right? So they should have best-in-class digital capabilities to begin with. Only slightly over majority, so 53% of the customers think or consider their digital bank's primary or digital bank's digital offering capabilities are completely satisfactory. So this leaves much room for improvement. And if you look at how these customers actually feel when it comes to bank switching, as well as kind of attrition risk when it comes to best-in-class digital capabilities, more than half, slightly over half, 51% of the respondents say they would never consider opening an account at a bank that does not have best-in-class digital capabilities. That's a very strong indication on what you need to do, right, to win over those customers. Meanwhile, almost like 40% of the customers want banks to behave like big tech, and this is an interesting result because about 7 years ago we did a similar kind of a question in the US in another survey. At the time, only 20% of the customers expected banks to behave like big tech. So that number has clearly doubled. So the expectations are pretty high there as well. And then about a quarter of the customers will switch banks without hesitation if the new bank offered better digital capabilities than the current primary bank. So digital capabilities are very important. if we go to the next slide, and you look at what banks have actually done in the current COVID environment. So around the world, there are quite a bit of a movement in terms of measures, right? These banks have started to offer, and most of those measures are digital measures, in response to the lockdowns, right, or temporary closures of the branches to a certain extent. If we actually divide these measures between two categories, customer-oriented measures versus operations-oriented measures, I would say there's a lot of movement. So pretty much, of course, this is not a complete list, but it is a representative sample of reasonably large banks in each of the regions doing something, right, in response. So if you look at some of the customer-oriented measures, UniCredit, for example, is going out with a campaign to educate customers of the existing digital capabilities that the bank has, to allow customers to interact remotely without having to go to a branch. Asta Group, which is a regional bank based out of Austria and a few other European countries, have gone out with some incentives to migrate customer behavior towards the digital channel. Chase in the US, has used digital channel to push, essentially educational measures on, these public assistance programs, right? In the US, it's the Paycheck Protection Program for businesses, as well as, kind of individual assistance by the federal government. So Chase has gone out with these campaigns, educational messages in the digital channel with that. Marcus, on the other hand, which Rick has referred to, from this morning's earnings call, it seems to be growing quite nicely. Have gone a step farther than everyone else by offering remote advisory capabilities. In fact, you could essentially, chat about your financial needs, and there will be a more tailored response through the digital channel to meet your needs. And then of course there are a few others like HSBC and BMO doing things in the customer-oriented sense. On the operational side of things, Danske Bank, which is the largest bank in Denmark, has gone out with a more consistent effort to enable remote selling, and you can essentially book appointments online and actually talk to a banker essentially of your product needs. BNP Paribas, one of the largest in France, enables digital infrastructure to better support kind of a whole host of digital activities. And then out of China, P9 Bank has actually developed some additional enhancements in collaboration with social networks over there to essentially promote essentially the one is to give comfort, right, to customers of their digital capabilities, and also at the same time they're actually linking up with supporting services, like for example, P9 is also an insurance company, so it's sort of not a surprising thing to offer information about medical services and access to additional things that might be relevant in the COVID environment, not just financial services, and so they're creating effectively an ecosystem there. And for the most part, none of these are completely transformative. It's a lot of those. I mean, if anything, P9 is probably the more innovative of the crowd here. Everybody else is kind of making do with existing capabilities. What are some of those measures which could be a bit more transformative, and how do you actually think about a resilient distribution strategy in this new environment where the physical branch network is getting severely disrupted? So if we go to the next page here. So there are a couple of things you have to think about. If you look at the customer journey, going from marketing to sales to activation to servicing, right? So marketing is you reach out to the prospect, and then they come to your website or point of sale, to open that first account, and then you activate that customer to be a primary banking customer, and finally, you have day-to-day servicing interactions with the customers. We believe the banks have to put in a number of measures on the to start, before you go into each of the steps in detail. There has to be a digital-led channel strategy that's put in place. A few years ago, the industry is hyping on omni-channel. I think a lot of those capabilities have been put in place. What's next, right? And so actually rethinking the digital channel strategy as well as the offline channel strategy, but in this case maybe it's more digital-led because of the COVID environment, is super important. And that includes things like outbound marketing orchestration. For example, banks even to this date are sending out offers in a fairly product siloed manner, right? So you may have a deposit offer and a credit card offer, and a personal loan offer that you push out to the customers. They're, to the extent that they're coordinated, is pretty much based on marketing calendars of a bank, and there's a reason for that. It's much easier to say that in March you run a mortgage campaign, in July you run a checking campaign. That type of broad stroke kind of coordination is easier to operationalize. Unfortunately, that's not how customers respond. Typically, they don't go by the banking marketing calendar. So thinking about your outbound marketing coordination and orchestration strategy in a way that's very, very personalized and targeted. That essentially there are triggers which are based on customer behavior. That will then prompt a certain type of offer to be sent to that customer, and then of course all the big data and advanced data science that you can put in place to actually quote that price right to the customers. That kind of a supporting analytics have to be put in place. So that first piece, which is orchestration, I think that banks need to think about adding that capability. The second piece is what we would call digital presentment and onboarding. What this actually means is, if you think about the 50% digital infrastructure capex being wasted that Rick introduced at the beginning of this presentation, part of where you should think about directing that money is if you look at where banks have actually been spending money on the digital front over the past 10 years or so. A few years ago, most of the banks are focusing on efficiencies, right? So the ability to open an account online in a way that's quick enough, and that doesn't result in kind of a clunky implementation that still requires customers to go to a branch to sign the paperwork. I mean, that was the main focus. What's missing is in an increasingly self-service channel, your ability to persuade the customer passively, right? Because you don't actually have a banker, actively selling that product anymore. So how do you make sure that the customer will actually be persuaded to buy the product? That requires applications of behavioral economics. That requires how you actually digitally design these interactive tools to present the products and making sure that they actually don't just only open the account, but rather they will also fund the account, right, with a behavior that's a desired behavior or the primary banking behavior. So there's actually a lot of additional digital work that needs to be done. And certainly for B2B applications, this third block, remote selling, is important. Business banking, commercial banking still largely relies on negotiations and person-to-person selling. So in the COVID environment where everything is shut down, you still have to do business, and how do you actually do that? You would have to rely more on a remote selling strategy. And finally, the fourth block, digital servicing. There are a lot of banks, that in the COVID environment has put out notices on the website to basically tell customers to expect longer wait time because the call volumes have gone up. But if you think about not just in the call center channel, there are certain things which you can actually implement that will make the experience a lot better. For example, Citibank in the US has a digital omni-channel capability on credit card charge disputes. So effectively, you can go on the mobile banking app or the online banking portal to dispute a charge. And when you actually have a complex situation, like it's a complex case, maybe the dispute doesn't immediately get resolved, and you probably have to call in, right, to explain to a human what that problem would be. When you actually call in, the normal bank would essentially force you to go through kind of a telephone menu. You have to press 1 here, press 3 there, and you have to do the dance before you actually get to the right department that can actually address your problem. Citibank has this implementation that actually allows people to, or essentially the robot will immediately call out or realize the fact that you're calling in is mostly because of this credit card charge dispute that you have. So the first question you get greeted is not the standard greeting and then listing out all the buttons you have to press before you get to the right department, but rather it was a question directly whether you're actually calling in because of this credit card charge dispute. And if you say yes, it will immediately redirect you to the right department, right? So that's a much more pleasant kind of a customer experience and definitely builds customer loyalty. So digital servicing is actually about using that kind of artificial intelligence, or at least the appearance of artificial intelligence, right? What you actually implement behind the scenes, it doesn't actually matter at the end of the day. It's that kind of a experience that you create for the customer. That's what banks should think about. And then underneath on the in-person front, let's not forget that branch channels will still play a very, very important role because customers don't want to dispense with branches completely. I mean, that's one of the biggest findings from our survey today. So it's not really a complete tipping point in the sense that everything's about digital after COVID. And no, branches will continue to play a role. So it will play a different role because of the gravity field chart that David has explained earlier, that maybe you don't need a very dense branch network, and also the purpose of the branch potentially will change. Our study showed, it wasn't in this particular presentation, but in the same study we actually found that customers are actually willing to do more digitally on account opening, but it's not 100% digitally. So there will still be people that want to go to a branch to deal with a very complex product need. So that calls for potential staffing mix optimization in the branch channel. Maybe you want to reorient kind of banker skill sets from teller servicing to account opening, right? So there has to be a change. And then finally, network realignment. Does it make sense to close down some branches because the density could be a lot thinner in the post-COVID world as people exhibit more digital behaviors or more willingness to engage digitally? Where do you relocate those existing branches to save some cost? That comes back to the first statistic of 60% bank expenses being network driven. So if you're able to save a little bit of money there, and then at the same time not waste 50% of your digital spend and pull that resources together and deploy it strategically into everything on this page, then you're on track to developing this resilient distribution strategy, or effectively the distribution strategy of the future. So just to close off, and if we go to the final slide, the key takeaways: physical branches will continue to play a role. As I said, this is not a tipping point where digital will take over from this point out. It will play a pivotal role, but it will play a slightly diminished role because digital does increase. Digital behavior does increase, but it will play a pivotal role in the sense that it's still instrumental in its acquisition power, right, or its ability to retain existing clients. Digital banking behavior saw an increase during the lockdown, especially for account opening activities, and then it's also expected to stick post-lockdown. So that goes to the point I made about enhancing your capabilities for digital presentment and the point of sale to make sure that you actually capture the increased inflow into the digital channel for acquisition related activities. A best-in-class digital experience will substantially increase travel time tolerance to the primary bank, and that essentially means there is opportunity to thin out the existing branch network and redirect resources for other forms of distribution, namely digital. Customers have high expectations for best-in-class digital banking capabilities, and then this will influence account opening as well as bank switching. And then finally, to create a proper strategy roadmap, financial institutions need to develop a systematic process to create resiliency. So if you think about just essentially what happens in the U.S. over the past few weeks, there are states that have been doing well and now all of a sudden are on the brink of closing down again. So I was just talking to a client, it's a regional bank. They had a bunch of branches in Texas that was about to open, and now they have to reconsider some of those decisions, right? So if that happens, how do you use alternative channels like digital channels to compensate quickly on the loss of the acquisition power from the branch channel, and in a way that is almost seamless and not disruptive to your normal acquisition capabilities, and that kind of a resiliency is what essentially every bank needs to do. All right, with that, I have closed off on this on the webinar portion, and we'll open up for any questions and discussions.
Hi, Wei. We will do the questions at the end. If that sounds good.
Yeah.
All right. Thank you very much for that insightful session, Dr. Ke, Rick, and David. And to everyone who is attending, if you could please pay attention to the screen. We'll put up a poll now, and if you could use that poll to let us know if you'd like a report to the survey, and we can make sure that we email them to you, the survey report that the Simon Kucher and Partners team just presented to us. Please use that poll to let us know, and we'll make sure that we send that over to you. So if I was to quickly summarize before we move on to the next speaker, what we just heard on a very high level is that we're seeing that bank branches are here to stay, right, despite the competition from neobanks and digital banks. But the roles that they play will change. And at the same time, banks need to step up their omni-channel game and optimize their omni-channel and physical branch strategies in a systemic manner to meet the growing customer expectations in what is to be the new normal. All right, so to move on to our next speaker, Madhur is someone who has 25 years of experience in the financial services industry with a specific focus on cross-industry convergence, open banking and monetization, digital transformation, business innovation, customer centricity, and customer experience management. To share his insights on the topic, I'd like to welcome Madhur Jain, Senior VP and Global Head of Solutions Consulting at SunTec Business Solutions. Madhur, now over to you.
Thank you, Ashwati. Good morning, good afternoon, and good evening to the participants. You heard speakers, that's Rick, David, and Dr. Ke speaking about the importance of a best-in-class digital banking capability and how that drives customer behavior. to very, very clearly what that means is, just a minute, please. Yeah, so the question of should we go digital is not a question anymore for any bank. Now, that was highlighted, that was known before, I would say, and very well highlighted by the survey you saw and the fact of what you heard from the speakers before. And it's not a question anymore of saying, should I be going digital? Is digital something which is a tack on to what I am doing today? Is it a part of my core operations? Is it a part of my core strategy? That's no longer a question. The question is much more about how would I be going digital? What should I be doing? What's the best way to make my organization digital? It's no longer, like I said, about is digital something which I should do, but it is about what is the best way to make my organization digital. Now, if I were to use this perspective and also add on to the fact of our current situation, where the new normal, as we speak about itself, is something which is completely unknown and is possibly something which is going to be very, if I would say, volatile, because you keep changing what's going to happen. The resiliency you would build, or the resiliency an organization can build in dealing with these kind of situations, is a fundamental part in how they would want to make their organization digital, right? And is there a simple mechanism which every bank or every organization can follow to say, how do I usher in the digital revolution in my bank? How do I make my bank completely digital? Is this something which I can look at it from a channel perspective, from an omni-channel perspective, focus on my, let's say, my distribution strategy? What are the things which I should do? Unfortunately, of course, there's no silver bullet which says that this is one size which fits all. All banks can easily follow this framework, and that's done. What is very clear is that sorry, that if you look at the spends which banks have done over the last few years, let's say 5 to 7 years, experience and information or analysis suggests that clearly 50 to 60% of the spend in banks are in the in the discretionary spend is happening much more on the digital side, but 90% of that spend is much more happening on the what I would call the channel space, not even completing the distribution perspective, but on the channel space. So you would see a number of best-in-class channel capabilities being brought in by banks, which actually improve the way their customers interact with the bank. However, innovating only on the distribution front, and here I am increasing it beyond the omnichannel and also including some of the portions which Dr. K spoke about in terms of enabling remote selling, enabling a resilient distribution strategy and otherwise. But actually only innovating and spending money or focusing on this layer alone leaves the digitalization story unfinished, because it is like a house half built. You have some key capabilities in the experience of the customer from an interaction perspective definitely improves, but it is not the whole story. Now, if a bank has to become truly digital, it needs to look at every aspect of its organization, from the organization's people, from the systems, the processes, the thought process, in fact, including, I would say, the way they measure their people, the way they reward their people. Everything has to be thought through before that change can be strategized and then operationalized. And I can speak of a few examples to kind of bring this to clear distinction, if I would say. By bringing in omni-channel processes which are brilliant, but by not being then able to allow, for example, the customer a choice in a dynamic world to change their interaction with the bank, their relationship with the bank based on their changing context or their changing lifestyle, fundamentally means that the digitalization or digital strategy stops at the channel, is not carried forward, and hence the overall experience which the customer gets is not necessarily the best or the most optimal. And hence, what we clearly see and what we are seeing where organizations are successful or where they have thought through how they can enable their entire digital strategy by looking at it in a holistic manner. Again, I repeat, from how their processes work, from how their people are organized, how their people are rewarded, how the people are measured, to what systems they have in place, and how do they make all of this work together. Now, in this context, let me speak about one critical piece of the overall digitalization strategy for bank, right? Now, orchestrating customer experience, and I am speaking specifically orchestrating the experience beyond only the point of interaction or the systems of interaction, which is, let us say, is the distribution side of things, is a very critical perspective. It does not help a bank if it is sold something which is extremely contextual to a customer based on their needs and the analysis of the needs. But then once it needs to be serviced, that whole process breaks down. And the experience is that the selling is completely remote, let us say, is completely driven by the choice of the customer. But as soon as now it comes to a dispute, or it comes to a service request, or it comes to something similar, it goes back to the traditional mechanism of doing things which are completely operational, let's say, or completely in one way human driven. And then the process breaks there simply because the time to address the customer's request, the time to service that, the efficiency in servicing that all is completely lost, then the overall customer experience is completely gone. And hence, orchestrating that experience through what we would call a customer engagement layer, or many analysts call what I would say is a digital core, which brings in that agility for an organization to be able to actually become digital and drive the distribution strategy, the digital distribution strategy, a resilient distribution strategy, by providing something which is an absolutely agile, flexible capability, wherein all the products and services which a customer would ever need, or which an organization would ever offer to its customers, along with the data which is required to take insightful decisions. And when I say insightful decisions, it could not necessarily be only from a person in the bank actually sitting and operating and deciding what needs to be done, but actually using data as the core or at the center of the decision-making process, whether that is driven by what the customer's requirement is, what the customer needs are, how are they analyzed, and how the bank will then take the next steps in using this data to actually interact with the customer and drive that customer experience. And obviously, the last part of it, or this particular layer, if I would say, is how would then they measure value delivered to the customer or all the other stakeholders, but also optimize that value which they are delivering to their customers. Now, if you look at what typically traditional banks have been doing, trying to, if I would say, tack on the digital strategy, working with their current core systems and building something which is very, very specific to their current core systems, their current multiple systems of, let us say, records, they are failing to anticipate or failing to build a resilient capability, which can be very fungible, which can be very agile and change according to what happens in the market. And this system of engagement, as you would call it, will then fundamentally alter the way a bank can engage with its customer and drive customers' experience by augmenting what's happening within the core systems and the other enterprise systems, by and bringing all customer engagement capabilities into a common enterprise layer, where then based on the customer context, or like Dr. Wei Ke said, that customers' expectations of an experience which, let's say, an Amazon or an Apple drives, these are elements which can be actually driven by this system of engagement because of the nature of this layer, which is agile, which is configurable, which is customer specific down to the segment of one, and completely changes the way you're interacting with the customer by providing them choice, by providing them personalization, by providing them transparency, and letting them drive their relationship with an organization. And that is at the crux of how, from a system perspective or from a process perspective, how can a bank look at actually changing the way their digital strategy is done today, or the way they would want to look at the digital strategy. Obviously, supplementing this is the entire perspective of how the people side of things is spoken or is managed. The distribution side of things is managed. You heard a lot about what speakers from Simon Kucher said in this particular seminar, and that's the way this perspective from a system side will enable a bank to actually deliver a successful digital strategy. Now, that then drives what we spoken about, the fact that the focus always has to be on the customer, because the customer expectations and the way they are interacting with other industries and their experience and how they perceive value and what value is being delivered to them by the bank is very critical. The other aspect of it is that increasingly, as you would see, that it is becoming not about the interaction between the bank and the products which the bank has versus what the customer needs, but the ability for the bank to orchestrate, should I say, a set of partners or partner capabilities and deliver something which is based on the needs of the customer is critical. So the value to the customer continues to be critical, but with the strategy which we spoke about, what you would end up doing essentially is award a truly personalized experience to your customers by actually giving back control to them. And this control is beyond what you spoke about in terms of remote selling or enabling them to get advisory on the channels, etc., but actually controlling their entire relationship with the bank in this scenario by themselves through the digital channels as one mechanism, right? And obviously this allows you to be extremely agile organization, which not only is able to compete in the market, be ahead of the market, improve time to market, and improve time to personalization to a particular customer, driving loyalty and growth, right? The last point about this is obviously all of this is driven by data, actionable, personalized data, which is real time, which can be and should be used at the center of the decision-making process to improve customer experience. And that's the perspective which I would bring to the table in terms of how a bank can think about furthering and enabling its digital strategy, going beyond what they're doing today, I would say, at the digital distribution layer and bringing it into a holistic manner across the organization. Thank you. Ashwati, back to you, please.
Great, thank you, Madhur. And you're absolutely right. To go digital or not is no longer a choice for banks. In summary, what we just heard from you is that digitization needs to be comprehensive and go well beyond just channel digitization, right? And to include the middle and back office systems. And the most efficient way, or the more efficient way to achieve this, is by adopting a customer engagement layer that can orchestrate interactions between the various customer touch points and the core systems. Also, now, thank you again, Dr. K, David, Rick, and Madhur. I'd like to request you all to turn on your cameras for the Q&A session. And attendees, you can still submit more questions if you would like. Great. So our first question, this is for the Simon Kucher and Partners team. How will the changes that we saw affect the pricing strategy adopted by banks with physical branches as well as the digital banks? What impact will this have on the end customer?
Wei, I was thinking, do you want to take that first one on pricing strategy?
So let me just make sure I understand the question. It's only about pricing strategy and how the channel difference affects pricing, right? So I think it's a tricky question to answer because it does depend on the different kind of regulatory environment you're in, depending on where you are in the world. Some of the countries like UK, for example, actually forbids to a certain extent channel-based pricing, but in other countries we do think that banks have actually realize the behaviors that customers exhibit digitally. So at least the ones that are willing to engage in the digital channel, in some way are very different. And in a lot of cases, they do exhibit higher price sensitivity, and as a result, you do see, for example, deposit pricing being more favorable in the digital channel compared to others. In the past, it was largely driven by a cost consideration. So if you think about why banks, direct banks, for example, are able to offer much better, interest rates for example, deposit products in the digital channel. It was largely driven by cost, but I think in more recent years, as more and more banks, deploy analytics on price elasticity, they realize that it's actually, not just a cost plus kind of a consideration, but rather indeed the price sensitivity is quite a bit higher in the digital channel versus the branch channel. So that tends to influence the pricing strategy going forward.
Maybe another thing I would add to Wei's comments is I think it also depends on what the bank strategy is to potentially migrate channels as well. So in this new world, we are looking to migrate more people off of, or rather we're seeing a stated movement from in-person to digital. And we are also seeing examples in that slide that Wei presented that banks are also introducing a number of promotions and incentives to essentially incentivize more of those type of digital behaviors. So in that sense, that type of pricing strategy will see more of in helping to shift customer behavior between channels.
Awesome. All right, question 2, and this is specifically to Dr. Ke. Can you share more examples on the digital innovations that might have been introduced as a result of the crisis, which you believe banks should have taken up earlier?
Yes, great question. So I'm just thinking there are things that banks have introduced. I'm not sure over the last 3 months they have actually necessarily done anything substantially innovative, as I've laid out in a particular chart. That it wasn't, it was like a lot of banks have done stuff, but I wouldn't say they're completely transformational. That being said, there are banks, and I can note, for example, especially in the bank, like I would say the kind of the bank assurance space. It's not completely banking, but it's banking plus insurance. There are banks in Asia that have deployed interactive digital point of sale tools that essentially uses behavior economics in a way to explain products and actually facilitate cross-selling and upselling very, very successfully. And that those type of applications are essentially being recognized and being appreciated. Of course, quite a few banks in Germany have done something like this, essentially using interactive tools to help that. But this was a few years ago, and more recently, it's sort of a few of those Asian banks in Thailand and Singapore and so forth that have started doing something like this. I think that those are developments worth noting and keeping an eye out.
Awesome. Unfortunately, we're at the 1 hour mark, so we do have to wind up. But thank you, gentlemen, for your time and all the wonderful insights. And thank you, everyone, for attending today's webinar.